What is the stock market? What are stocks? What are securities? What are we doing here?
Show me the money. Look at all that green, baby.
Wealth creation right in front of our eyes.
Cha-ching.
The history of the stock market dates back to the 17th century with the Dutch East India Company, who sold shares of stock to finance their voyages across Asia. More money for the company meant that they could go on more fancy voyages, grow their company, and do fun stuff. But as an investor of the company, there's a risk of the ship not making any money because, pirates, scurvy, and misappropriating investor funds. The first stock exchange was the Amsterdam Stock Exchange, but who cares what Europeans are doing? In the United States of America, the first stock exchange was established in Philadelphia in 1790. Right by the water!
My boy's wicked smart.
Sorry. The New York Stock Exchange was founded in 1817 and is one of the largest now. Hey, I'm walking. Sorry.
Talk like that, we don't say things like that, you understand? Do you understand?
Okay, sorry. Forget about it. So
In the early days, the stocks were traded in person on the trading floors of the exchanges, but with technology, electronic trading became more common. Shares of stocks are traded on stock exchanges and their prices fluctuate based on a variety of factors, such as a company's financial performance, news affecting the industry, global economic conditions, or even a community of nerds with gaming addictions. Throughout history, the stock market has had many booms and busts, including the stock market crash of 1929, which led to the Great Depression, the dot-com bubble of the late 1990s, and the 2008 global financial crisis.
Honeymoon is coming to a close in many parts of the world.
.coms have become .bombs. 300,000 tech jobs are now gone.
It's described as nothing short of breathtaking, a points drop never before seen on the US market. It left traders and investors shell-shocked.
Despite these challenges, the stock market has continued to play a crucial role in financing businesses, creating new industries, and providing opportunities for individuals to invest and build wealth, as well as, fueling the inequities of global capitalism and pushing a neoliberal ideology into social life. But what? Right. Back to work. Gotta pay my bills.
Now it's currently up by 100.
The NASDAQ finally hit 5,000.
And investors are salivating.
Is this a bunny?
Stocks. What are stocks? Stocks represent the ownership of a company. When you buy a stock, you essentially become a part owner of the company and you're entitled to a portion of its profits and voting rights in company matters. Shareholders can also benefit if the value of the company goes up because the stock price will go up and they can sell their shares for more than they purchased them for and take a profit. Business, baby, it's so hard, very difficult, tricky stuff, money moves, all that.
Watch your money grow. Whoa, you're gonna make a lot of money.
Thank the market gods. Because, baby, this stock is born to run.
Some stocks, not all, pay dividends, meaning shareholders receive some sort of payment, usually cash or sometimes more stock for holding the stock. But not all stocks pay dividends, and they often, reinvest it into the company instead of paying it out. This is where the sort of finance stuff gets a bit tricky, but who cares? I don't care.
The stock market goes, so goes the wealth and the health of the American economy.
What the market is telling us is that we are on the road to
In
prosperity.
the skyrocketing stock market, and that benefits everyone.
The stock market has gained almost $3 trillion in value since the election.
Fun stuff. Stocks can be from private or public companies. Private companies have limited ownership and fewer regulatory obligations, and they can only raise money through private means. Private companies can go public through an initial public offering.
70 record closing highs so far for the Dow.
Blasting through a ceiling. In a record-setting
Being a public company, it's not all great. Even though you have access to the public capital markets, they faced higher costs, regulatory scrutiny, but you have access to more capital and you can sell off your stocks whenever you want.
I'm not a cat. I am not an institutional investor. rallied around GameStop and executed a short squeeze.
Securities are a broader concept. Stocks or shares are one example of a security, but others include bonds, derivatives, mutual funds, ETFs, and maybe even cryptocurrencies. We don't know yet. We know what stocks are. They're just partial ownership of a company that gives you certain rights like profit or voting. Bonds, on the other hand, are debt securities that represent a loan made by an investor to a company or government. The issuer of a bond, the company, agrees to pay back the investors the principal along with some interest over a specified period of time. Basically, these are fancy IOUs. Derivatives are securities that derive their value from an underlying asset or financial instrument, such as stocks, commodities, or currencies. Examples of derivatives include futures contracts, options, swaps, and this is where people really try to gamble with each other. Sorry, not gamble. Manage risk.
I've been working on the railroad.
ETFs and mutual funds are just a basket of different securities. However you want to pick and choose securities, stocks, bonds, the biggest companies, tech companies, whatever, however you want to slice and dice it. But ETFs or exchange traded funds trade on the stock market, and they're not actively managed, meaning nobody is really looking at them very closely all the time. Mutual funds differ because they're usually actively managed. There's other marginal differences, but who cares? I'm a professional. I went to law school. Securities are regulated by the US Securities and Exchange Commissions, the SEC. We're really a fun group of people.
The SEC are committed to our mission on behalf of investors and issuers alike, and ensuring that the markets that connect them works for them.
In 1946, the SEC came out with a decision on Howey, major case in securities law. Here, Howey sold tracts of citrus groves to investors, so pieces of the citrus land, and they offered service contracts whereby they would tend to the groves and harvest and market the produce. So you buy a tract of land, you have a company kind of grow oranges or something, and everything is sort of hands off. Most buyers, they wanted it to be hands off. They weren't residents of Florida, they lacked agricultural expertise, and they relied on these service contracts so that their investment in this tract of land would succeed. The SEC brought an action against Howey and this Florida-based company for selling unregistered securities. As we know from the Securities Act, all sale of securities must be either registered or fall under an exemption. The primary legal issue was whether these transactions constituted an investment contract and thus a security under the Securities Act of 1933, requiring registration with the SEC. All securities must be registered or fall under an enumerated exemption under the Act. Fun stuff.
Americans were using their hard-earned money to purchase securities, but they weren't often getting the right information. They were getting flim-flam, purchasing securities from hucksters and con artists.
The US Supreme Court ruled in favor of the SEC, and the court established the Howey test to determine what constitutes an investment contract and what counts as a security, really. Here in the Howey case, the investors didn't themselves tend to these orange groves. They relied on a related company, Howey and Health Services, to do all that work for them. The Howey test became standard for determining whether certain transactions qualify as investment contracts. The Howey decision made a lasting impact on securities regulation. It continues to be a pivotal point of reference for various contexts, including various modern cases involving cryptocurrencies or other financial instruments. Okay, that's enough law for me. Let's move on to the finance stuff. There's a lot of players in the stock market, but Let's just focus on the most popular: investment banks, asset management companies, and the retail investor.
We're not lawyers. We're investment bankers. We call you for the paperwork.
Investment banking, IB, the Goldman Sachs, Morgan Stanleys, and JP Morgans. They're specialized financial institutions providing a variety of financial services to corporations, governments, and other institutions. They play a crucial role in financial markets by facilitating capital raising, providing advisory services, and engaging in trading activities. This includes underwriting securities such as stocks, bonds, where they determine the price, purchase them from the issuer, and then sell them to investors at a profit. Additionally, investment banks assist private companies in going public through the IPO process, enabling these companies to raise capital from the public for the first time. In the realm of trading and sales, investment banks engage in market making, buying and selling securities to ensure market liquidity. They're fancy fundraisers.
Warren Buffett, the biggest Wall Street titan of them all.
America's most famous investor.
Investor Warren Buffett is worth $84 billion.
Asset management companies, the BlackRocks, the Vanguards, the Fidelities, are financial firms that manage investment funds, portfolios on behalf of individuals, institutions, and governments. The main types are mutual funds, hedge funds, private equity, and pensions. These are different large pools of money that go for investment. Their primary role is to invest client funds into various financial instruments to achieve a specific investment objective. Hedge fund, you want to hedge. Mutual fund, slow growth. Private equity, big growth. And pension, just stable, very slow growth. One common way to distinguish between investment banks, although there are a lot of overlaps between investment banks and asset management companies, is that investment banks are usually the ones selling and asset management companies are usually the ones buying. Asset management companies, they have a pool of money and they need to invest that somewhere. Asset management companies select and manage a mix of assets, including stocks, bonds, real estate, commodities, and create a diversified investment portfolio. Portfolio diversification is a key function of asset management companies. Portfolio diversification is a key function of asset management companies. By spreading investments across various asset classes, sectors, geographical regions, asset management companies aim to reduce the risks associated with poor performance in a single investment. This is good practice across the board. Research and analysis are critical components of asset management company operations. They employ financial analysts, investment managers who conduct in-depth analyses of market trends, economic data, and company performance. Risk management is another huge component of asset management companies. They employ various strategies and tools to mitigate risk, ensuring that investment portfolios align with the client's risk tolerance and investment objectives. Continuous performance monitoring and reporting are also vital functions. Asset management companies track performances of investments and make necessary adjustments to optimize returns.
His decision flow process is Google, Exxon, Procter & Gamble, same as any old lady in Kansas City, except she won't charge you $2.20 for it.
In addition to managing investments, many asset management companies offer comprehensive financial advisory services, which help clients develop investment strategies, plan for retirement, manage taxes, and achieve other financial goals. Essentially, they just help rich people get richer and stay rich.
There's a sense of growing prosperity, and the telephone company is a grateful participant.
Retail investors are you and me, the non-institutional investors. Maybe we have our little brokerage accounts with Wealthsimple or Robinhood, and we try to mimic the research and analysis of these billion-dollar companies with our little Google searches and TikTok astrology courses. Or maybe we're a bit more sophisticated, or like to believe so. We completed our level 1 of the CFA and watched Aswath Damaradan lectures while pretending to know how to read a 10K. It's easy to get overwhelmed when you're competing with quantitative traders with PhDs in supercomputers, analysts working 90-hour weeks researching one company, or, frankly, illegal practices by these institutions. But it's important not to fall into the hype of these stories of windfalls of money and try to take a shortcut to gamble away all our savings or fall victim to scams. For the vast majority of people, your best bet is to stick all your money into an
S&P 500 low-cost index fund
and just forget about it. Going off script for a minute, I think there are small ways that retail investors can change and influence the behaviors of these giant companies. We can play the game of neoliberalism and vote with our wallets. Buy the stocks of companies that support greener initiatives. Vote in the directors that are equally qualified but are from underrepresented groups. Bring to light any unethical corporate practices. As the great Caesar said,
apes together strong.
Stock market got off to an impressive start.
The stock market set another record today for the record books on Wall Street.
The U.S. economy charges ahead, and so do